Hello and welcome to this week's podcast, brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker, providing trading services in forex stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me once again is Pepperstone Senior Market Strategist Michael Brown, and we've certainly got a fair share of market gyrations to chew over today after last night's announcement of a 90-day delay to the implementation of tariffs by the US administration, obviously with the exception of China, who've been clobbered with a 125% tariff rate. So, Michael, did Mr. Trump blink? And if so, was it the stock market or the bond market which prompted the shift?
Well, very good afternoon to you, mate. It has been quite a whirlwind since we last spoke a week ago, as you rightly allude to. I think it's the bond market. Ultimately, Trump has tried to bully every other country into negotiating with him and bully the market into submission. And we can't bully the biggest one of them all, which is the Treasury market. And 5% on the 30-year yield was a bit of a stretch too far for him. And I think he lost his bottle, really.
Yeah, could you say he lost his bottle, or was he just being pragmatic? Ultimately, he was ignoring the stock market. People's 401ks were going up in smoke. Didn't really appear to bother him that much. But when your funding costs go up, as Liz Truss found out,
Well,
maybe the bond market is the ultimate arbiter of fiscal responsibility, perhaps.
yeah, no, I think it absolutely is, and certainly when even if you are issuing the reserve currency, even if you are the United States, when you're running a 7% budget deficit, the market isn't going to be particularly forgiving, I don't think.
Mm. What I think was particularly interesting, was the fact that US Treasuries were initially acting as a safe haven, and then that suddenly just completely flipped on its head. Yeah,
Yeah.
what do you think caused that? Actually, before you answer that,
I was going to say you printed it off, especially, so you better read
yeah,
it
I
out.
did, yeah, because I mislaid it. Yeah, I think better do the risk warning, because otherwise we're at danger of forgetting about it and then sort of moving into territory that compliance would start to get a little bit twitchy about. So
I get pulled
um,
out by the collar.
yeah, so let me just dig out the risk warning. It's right here. So just before we get started, the information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 74.8% of retail investor accounts lose money when trading with this provider. Okay, so back to my original question.
I can't remember what it was. It's been that sort of a week. Was it why Treasury stopped acting as a haven? Was that it?
That's it. Basically,
Right. There
it
we
just
go.
suddenly flipped. From
Yeah.
acting as a haven, yields suddenly spiked, and there was some sort of chatter about China perhaps starting to sell down its treasury holdings. I mean, for whatever reason China has to disagree with the US, I think that's the financial equivalent of shooting yourself in the face, because ultimately you're going to run out of buyers if you start to do that.
Yeah, no, I fully agree, and I don't think that was the case. To be clear, I think that was a few people on social media getting a bit ahead of themselves. I think the most obvious sort of catalyst for that would have been effectively people needing to sell down positions to raise cash in order to put up margin elsewhere. I think that it also explains why we saw gold struggling towards the back end of last week and also at the start of this week, where effectively you've got a situation where participants have a book of positions. They need to put up additional margin in order to fund or keep open some of the positions that are now underwater as equities have moved lower and also as realized vol has increased quite sharply. But what do you sell in order to raise cash? Well, you want to sell things that are relatively high quality, relatively liquid, and you're probably going to sell the winners first. And if you look at what's done well recently, long treasuries and long gold have been two positions that have traded well. So I think that's why we saw what was arguably a counterintuitive move, where treasury yields rising despite sentiment being as bad as it has been at any point in the last sort of 5 years or so. But what I would say is there is also potentially another narrative of, are people starting to think that the US political landscape is getting too volatile and too shaky for their liking. I think it's quite telling that as we sit here on Thursday afternoon, probably about a day on from Trump's remarkable U-turn, the equity market is about 10% higher, but the 10 and 30-year Treasury are basically where they were on Tuesday morning and still up by about 35 basis points on the week. And I think that's quite a telling message in my mind.
What was, I think, particularly noteworthy, Michael, was the fact that we saw movement in the long end as
Mm,
opposed to the short end. The short end didn't really move. Well, it moved, but it didn't move to the same extent as the long end
no.
did. Saw the 30-year, hit its lowest level since 1998 in yield terms, highest levels. The
Mm,
10-year spiked as well. It was at 3.9%, I think, about a month ago, and it went up to 4.5.
yeah.
So if that doesn't concentrate minds, I don't know what does. But what's particularly interesting is we've seen a little bit of a correction in that, but certainly not as big a correction as perhaps you might have wanted to see. Because as I
Mm.
look at it now, the US 10 years around about 4.33%. So it's only 17 basis points down from the peaks anyway.
Yeah, no, absolutely, and I think that's interesting that the equity market has been sort of overwhelmed with this sense of euphoria, whereas the Treasury market, as you typically tend to see, is taking a slightly more realistic assessment of things. And again, I just wonder whether that's a case of yeah, yes, it is undeniably good news that the reciprocal tariffs have been postponed or paused for 90 days, but you still have what's effectively a trade embargo between the US and China, given how high the tariffs are, and you still have a 10% tariff on all other imports into the States, which is going to cause a significant inflationary impulse and also a significant headwind to growth. And I think that's something that treasuries are probably pricing a lot better than equities.
Yeah, I mean, I was struck by the fact that the market reaction yesterday. I mean, let's put this in context, right? We saw some really big moves in US markets last night.
Hmm.
The Nasdaq finished the day up around about 10%, if I'm not mistaken.
Oh, yeah, I think it was nearer 12 actually at
Yeah,
the close. Yeah.
and I think if you look at the weekly chart, we've seen a very, very strong rebound. We're giving back, I think, a little bit of that now,
Hmm.
which is perhaps not surprising. But you look at European markets. I mean, this time last week, we were looking at the FTSE at 8,400.
Hmm.
And the DAX, we were talking about 21,000 as being the big level. We've gone through those levels like a knife through butter. We've been through 8,000 on the FTSE, down to as low as, I think it was around about 7,540.
Hmm.
And we're now just below 8,000. So we're still down on the week
Yeah.
from where we closed at the end of last week. So we've seen a rebound, but we're still we're still quite a bit lower on both European markets, even if we're not on US.
Yeah, well, actually, we are still in stateside, and I don't have a chart in front of me now, but I believe that we are still below the level that we were trading at before the Liberation Day tariffs were announced on the 2nd of April. And I think, again, I don't want to become a sort of technical analysis tourist here, but reclaiming those highs is probably going to be quite key in order for the market to become a little bit more confident that the rally is durable and not just a sort of technical knee-jerk rebound on good. We've got some good news. Let's all just pile in as quickly as we can.
Yeah, I think this ties into a piece that actually Jackson's written on the Good Money Guide website. Is now a good time to get back in to buy stocks? I'm always a little bit reluctant to sort of venture down this particular rabbit hole because essentially there's never a bad time to invest in stocks and shares because ultimately you're investing for the long term. So, as long as you're not paying the top on a particular market, and certainly no one's suggesting they're doing that given the fact that we're down quite heavily from the peaks. I think if you've got a long-term strategy in place, and
Mm.
investing in stocks and shares over the long term generally tends to pay off. But he's highlighted three or four stocks in particular: Apple, Tesla, and Nvidia. Well, Apple rallied hard yesterday on the back of that announcement, and that puzzled me a little bit because Apple's got a huge presence in China.
Yeah,
125% tariffs on an iPhone that's basically constructed over there. That's not going to be particularly good.
no, I think the Apple rally makes a little bit more sense to me because I think it's a case of it will be a bit easier for them to get round the tariffs now. Yes, the China tariffs are quite frankly insane and will hit anyone who has manufacturing within the country. But we also know that Apple have been seeking to diversify their manufacturing quite considerably over the last sort of 4 or 5 years. They've got plants in Vietnam. They've also got plants in India as well. So I think the fact that Vietnam, for example, tariffs have gone from 46% to 10%, and we've also got the Vietnamese who are sort of close to the front of the queue in terms of getting that potentially to zero. If they can strike a trade deal, I think that is what the market is buying into. And also, there's been a number of reports specifically in terms of Apple. They do seem to be quite proactive at the moment in terms of trying to get ahead of and get round the tariffs. I mean, I saw a Reuters story earlier on saying that they've just flown 600 tons worth of iPhones. I don't know how many that is in terms of actual handsets from India into the United States in order not to be exposed to that higher levy from China.
So maybe the tariffs won't take a huge bite out of Apple's margins then.
Oh dear, dearie me. I must admit, I did place a trading halt on my puns earlier in the week, but now we've rallied. I think that halt can come off.
Yeah, well, you know my views on that after my tweet.
I knew you'd be pleased, mate. It is on a slightly more serious note, though. I do want to just caution on that because one thing we have heard from Trump himself and also Peter Navarro, one of his senior trade advisors, one of the things they do keep talking about is this idea of effectively countries allowing people to come through the back door and export from China via a third nation. So, for example, make something in China, ship it to Vietnam, then fly it to the US, you pay the tariff on Vietnamese imports, not on Chinese imports. So I do just wonder if, or indeed when, the administration sort of turn around and go, well, hang on a minute, we've put these tariffs in place for a reason, and you're now just helping companies to avoid them. I can't imagine they're going to take a particularly positive view of that.
Mm. Is this the same Peter Navarro that Elon Musk compared to a bag of bricks?
Yes, and I think that's the same Peter Navarro whose Elon Musk's assessment of him is absolutely spot on.
Mm. Yeah, because I noticed that obviously Musk's front and centre with respect to this and Tesla, and I think he's starting to come under pressure to actually start focusing more on Tesla, given the fact the share price has come down from nearly $480 to, well, it's more than halved. It's bounced off 200, just above $200 earlier this week. It's heading back towards 280. I mean, that's a sizable erosion of shareholder value right there. Have we seen the bottom in Tesla? I think that $200 a mark, $200 mark is quite significant. It's been the lows pretty much for the last 9 months. So
yeah, no,
the
definitely.
technicals don't look particularly great on that.
No, it does seem to have run out of charge a bit. The one thing I would say is there have been these concerns about Musk for quite some time now, I think, whereby, investors in Tesla have been saying you're trying to run a car company, you're trying to drill tunnels under various cities in the US, you've got Neuralink, you've got SpaceX, you've probably got 3 or 4 other things that I've forgotten at this point. Now
Starlink.
you're Starlink, of course, yes. Now you're trying to run the country as well. I think we've almost got to that sort of tipping point of can you actually just focus on the one thing that we're actually invested in without spreading yourself too thinly, effectively? I think that is driving quite a chunk of the downside. Yeah, we saw a rebound yesterday, of course, as everything rebounded. But you consider the impacts of potential tariffs on top of that, and I think really what's going to unlock considerable upside for Tesla is if Musk turns around and goes, I'm out of Doge, I'm back into Tesla, I'm strapping into the CEO role full time again.
Yeah, I mean, obviously his biggest competitor is BYD, but also I think an awful lot of the legacy car companies are starting to catch up on that. I think for me, looking at the shares at the moment, we need to see a move back through $300. I think that would signal that potentially we've seen a short-term base, but at the moment, technicals 50-day below the 200-day, below $300. We need to see a move back above that trifecta of resistance. Which
you're bringing out all the fancy words now, aren't you?
Probably the highs that we saw in March. But yeah, no, absolutely. But for me, it's about price action. It always has been about price action, and sentiment changes. And at the
Yeah,
moment,
and talk about a
um,
sentiment change this week.
well, have we? I mean, the thing is, the big thing for me is how much damage
Mm.
to business confidence has the events of the last few days really done, particularly within the US, um, as well as outside the US, and the faith in
Yeah.
the US government, as and its institutions, if you
Mm.
like.
Well, I think this
Um,
is this is the thing, and I wrote this in my morning sort of comment this morning. It's actually a case of fine. Trump has pulled a U-turn, and the market's bullied him out of his tariff policies, and he's caved in, he's folded over, etc., etc., etc. Great. The issue is now he's done it once. What's to stop him going back and doing this again and again and again? I don't. I think for me, this is almost a case of if we've spoken about policy uncertainty and incoherence in how the White House are acting. I think this is great evidence of it. And on the basis of this evidence, it doesn't look like we're going to move to a sort of more normal, stable political environment anytime soon.
and I think that's the point. I
Hmm.
think, yeah, we've seen a rally, but looking at it now, we're giving back some of that,
Hmm.
which you would expect anyway.
Yeah, such a
Um,
huge move.
but Tesla's down 5% as we speak, and it's giving back some of those gains. And I think as we head towards the end of this week, I think we're going to get a certain amount of repositioning
Hmm.
for this new environment, potentially that we're in, this new uncertain environment. Yeah, there's a 90-day pause, and certainly Bill Ackman was one of the
Oh
first people to
God.
break cover and suggest the 90-day pause. So we've seen that. The bigger question is what happens between now and July. And at the
Hmm.
moment, I think there's a great degree of uncertainty about that. And certainly, I think the EU's response yesterday was boneheaded in the extreme. And ultimately, I think Trump bailed them out to a certain extent because they were going to retaliate. I mean, what's the point in sending Giorgia Meloni, Prime Minister of Italy, to Washington to negotiate on their behalf and then announce tariffs, retaliatory tariffs, in response to US ones? And we talked about this last week. It's just
Hmm.
boneheaded.
Yeah, no, I completely agree with you on that one. I think the 90 days thing is interesting because it raises so many questions. The obvious one is it takes a hell of a lot longer than 90 days to get a trade deal done. Even if you can negotiate quickly, these things need to be ratified by parliaments on both sides of the deal, etc., etc., etc. Lawyers are getting involved, all the rest of it. So the first question I have is what can you actually do in 90 days? The second question is it only 90 days? Because if you recall with TikTok, which I believe we are now going viral on every now and again, the initial deadline for a TikTok sale in the United States was 90 days. That's now been extended twice since President Trump took office. He did it first back in January, did it, he's doing it again in the coming days. So I think that's the other thing is, does this then just become a sort of pause that's effectively as good as a forever halt, but just on a sort of rolling 90-day basis. And if it is, then that's a huge amount of uncertainty, not only for markets to be dealing with, but also businesses. And I think, you mentioned business confidence. Great, tariffs are on pause for 90 days. If you're a large corporation or even a small corporation, are you going to make investment decisions based on the fact that the whole landscape could flip on its head again on the 8th of July? Of course you're not. You're almost by doing that, and yes, it is a market positive based on the move yesterday, but you're almost sort of guaranteeing that the economy is just going to be in a bit of a deep freeze for the next 3 months because no one's going to have the confidence that at the end of that 90 days, we're not just going to go back to that stupidly large poster that Trump was parading around the Rose Garden and say, here are the tariff rates, deal with it.
That sounds familiar, doesn't it? Well, we've been living that since the October budget, haven't we,
Yes,
here in the
absolutely.
UK?
It does feel like we're going round in circles.
Hmm. Only this time it's the world's largest economy,
Hmm.
taking the spotlight away. On that score alone, I mean, obviously UK gilt yields have gone up in response
Yes.
to what's happened. What's actually quite interesting though is that they haven't come back to the same extent. But then again, they didn't go up that much anyway. Certainly not on the
No, and I
5 years.
think
So it's probably not going to affect mortgage rates to the same extent. It was the long end that again took the heat, wasn't it, here in the UK? The 10
it
and the
was.
30.
Yeah, and I think that is actually quite worrying. The 30-year yield was up by about 30 odd basis points on Wednesday. We've come off a little bit since. We're still close to the highest yield since 1998. But what we actually saw today was the Bank of England coming out, not with any policy measures, I must stress. But what the BOE have been doing for some time now is actively selling down their gilt holding in order to reduce the size of their balance sheet. And the BOE were due to be selling off what they call long maturity bonds, effectively that 30-year onward segment. And that was due to take place on the 14th, so early next week. But they've actually come out today and said, due to the market volatility, we're going to sell bonds at the short end of the curve instead, and we're going to hold back on that long end sale until the third quarter of the year. And I think that's just an interesting one because, it's sort of the first and potentially only sort of policy response that we've seen to the well, I guess you can call it turmoil in global fixed income markets. Now, it's worth bearing in mind that BOE are being a lot more aggressive than anyone else with those balance sheet runoff plans, doing the active sales rather than just letting things roll off as they mature. But nonetheless, it just sort of points to a degree of nervousness among policymakers as to the market moves that we saw over the last couple of days. And I guess in terms of the counterfactual, you become almost thankful that Trump did pull the U-turn that he did because, well, goodness only knows where we might have ended up today if he didn't.
Yeah, indeed. But I think there's also an opportunity here for the UK government, I think, to lower their borrowing costs, because what they could do is something that the Fed did back in the day, something called Operation Twist, where they basically put more money into the shorter end to fund themselves than the longer end where rates were higher. Because an awful lot of UK debt is very long-term denominated, which obviously insulates us from short-term interest rate movements. But obviously, in a situation like we have at the moment, where long rates are staying higher for longer, perhaps it's worth issuing more short-term debt and letting that long-term debt roll off.
Yeah, no, I think that's definitely something that will be, well, you would hope it will be up for debate at the DMO and the Treasury. I'm not sure I'd be sure it will be. The DMO have been doing that for some time now, actually, in terms of increasingly weighting sales towards the front end of the curve. But yeah, you're absolutely right. If we do see the front end continuing to rally, then absolutely it makes sense. And certainly when you're dealing with fiscal headroom that's as wafer thin as we are at the moment, anything that you can do to increase that even by a couple of billion is worth doing.
Yeah, you've got to do it, even if it, just to buy yourself some time. You still have to address the underlying issue of
Oh,
rising debt
absolutely.
levels. But, and that's the issue here at the moment. There's no indication that this government or any other government in waiting has a plan for that.
No, and I think this is sort of a problem, and I think we probably discussed it before the spring statement a few weeks ago, whereby we're talking about rebuilding the fiscal headroom. Yeah, but we're only taking it back to 10 billion, which is a third of the average that it's been over the last couple of decades. No one is actually talking about saying how do we build a buffer, how do we sort of prepare ourselves for what will inevitably happen in the future in the form of a crisis or a recession, whereby you then need to be able to release some stimulus into the economy. That conversation is not being had because I would imagine that civil servants and government officials and members of parliament have just sort of thrown it in the too hard box, swept it under the carpet, and hoping that someone else can deal with that in the future.
Manana.
Exactly. And at some point, tomorrow will come.
Yeah, exactly that. Looking at a UK stock that's done particularly well in recent months is Rolls-Royce. That fell quite sharply as well, on the back of on the back of obviously those tariff announcements. What's quite interesting about that one is it's rebounded off the 200-day moving average. It's rallied quite hard. Um, it's rallied quite hard today, but again, it's actually gone almost back to 800p, the highs that we saw in the middle of March. So it's more or less recovered around about half the losses that we saw from the peaks there. So again, a fairly decent rebound from Rolls-Royce just on the back of just one announcement. I mean, I think
Yeah.
it just gives you an indication of how fickle these markets are.
Well, absolutely. And also the other thing, unless I've really missed something, and given how much of a whirlwind this week has been, it wouldn't particularly surprise me. Rolls-Royce, most of their stuff exported to the United States. Certainly the stuff that they're exporting from the UK, the tariff rate hasn't changed, despite what
Mm.
Trump said yesterday. We were already at 10%.
Yeah.
So obviously they've got manufacturing all over the place, but it does feel again like a little bit of a case of the market overreacting to the negative news and then also overreacting to what was taken as the positive news that we got yesterday.
I think it's like a fiscal tsunami. What happens is it sweeps everything away. Some
Mm.
stuff comes back to where it was, and
Yeah.
other stuff doesn't.
And sometimes some of the other stuff takes a little bit of time to
Yeah.
get back where it was. It's certainly this is the thing. It's not this sort of event is not something that markets can, fully discount all the implications of within the space of what 6 trading sessions.
It'll take a
It
while.
takes a hell of a lot of time for everything to properly shake out. And I think, on that note, one of the things that I'm keen to see sooner rather than later is the United States getting some sort of deals struck. Japan are supposedly in the front of the queue, South Korea potentially as well.
Mm.
But I think when, or indeed if, those deals are arranged, not only will it give participants a little bit of hope that actually a lot of these tariffs could come off or be permanently reduced at the end of the 90 days, it could also serve as a bit of a blueprint to some of the other countries that are going to be negotiating to essentially go, well, Japan promised this, South Korea promised this, let's do the same and, hopefully speed up our own negotiations.
Well, the German Chancellor, Friedrich Merz, basically said, let's just have a free trade area between the EU and the US.
Yeah.
I mean, where was that when we were negotiating our Brexit deal?
Well, yeah, quite. I mean, this is where it comes back to what I was saying about,
If you shout loud enough, if you shout loud enough and you stamp your feet hard enough, then the EU will agree.
well, it seems that way. Let's see if it actually comes off or not first. As you said, Brexit took a year, USMCA took 13 months, a lot of other trade deals. I mean, you're getting close to measuring it in decades to get them over the line. I know Trump's putting a lot of pressure on, but some things only move so quickly at the end of the day.
This is what I find, all this hand wringing about Trump so hypocritical, because at the end of the day, the EU is just as guilty of anti-competitive practices as the next person. So spare me your crocodile tears. If you want a free trade deal, negotiate a free trade deal. No conditions, no negotiations about fishing rights or anything like that. Just basically do what's beneficially good for both economies. Both sides of the economy. It just drives me mad, the hypocrisy of it all.
And rightly so, may I?
Anyway, just now that I've got off that particular soapbox, going back to the original article, when is now a good time to invest in stocks and shares? There's never a bad time. Obviously, as long as your time horizon is long enough for you to make an informed investment decision on the basis of what's going on at the time. Stocks and shares is very much long term.
Yeah, absolutely. I mean, clearly we're not offering any sort of advice on this podcast, but
well, everyone's got a pension, Michael. You have, I
absolutely.
have. We all invest in the stock market to a greater or lesser extent. It's very much.
Yeah, and even those without, with other investments, things like ISAs or whatever it may be, generally you're talking about, an absolute bare minimum of a 5-year time horizon. You're not day trading or swing trading. You're putting this money away for it to appreciate and grow over a prolonged period of time, and potentially with some dividend income or even dividends being reinvested over that same period. I think, I'm pretty sure it was Bank of America, but I might have got that wrong. I've read so much this week. Put out a note Tuesday, I believe it was, along the lines of, generally speaking, the best days in the equity market tend to come pretty shortly after the worst days in the equity market. And of course, that's where the old phrase of time in the market trumps timing the market, because you will never buy the bottom and you will never sell the top. And if you do, it's probably a fluke and you won't be that lucky next time around. And that's why over the last sort of week or so, as we've seen all this turmoil. For longer term investors, the absolute best thing to do is just stay there. Close your brokerage app on your phone, check it in a week when the market's in a different place, and just try and ride it out as best as you possibly can.
You should put that on a t-shirt, mate.
Yeah. Well, to
Time
be
in the
fair,
market as opposed to timing the market.
well, I might get it on a baseball cap instead to cover up my receding hairline, which has only got worse by what's happened
Behave.
this week.
Got more hair than I have.
I've also
Anyway,
got 30 years on you.
I think I said that. So basically, I mean, bottom line, I think at the moment for markets is we're in a wait and see mode. Yes, we've seen a decent rally off the lows. Have we seen the lows? Yeah, it's really hard to say. I mean, I still think the long-term case for stocks is a good one, assuming no more black swan events and unpredictable behaviour out of the White House, none of which is a given. But ultimately, I think for me, I want to see him. I want to see us get back above 8,000 and hold above 8,000 on the FTSE 100 to really sort of establish some sort of foothold and evidence perhaps that a base is in. And similarly, I think with the DAX, I'm looking at the DAX, and obviously it's well off the highs at the moment. I want that to stay above 20,000, and we're about 20,500 at the moment. I have this thing about round numbers. It's a
I think
market thing.
everyone does.
It's from my FX days. 130 on cable, for example. Sort of 110 euro dollar. $100 yen, $150 yen, that sort of thing. They're psychologically important in the wider scheme of things. And, certainly I think they influence human behaviour. So for me, I think if we can hold above 20,000 on the DAX, we can hold above 8,000 on the FTSE 100, my confidence will grow that perhaps we've seen the lows.
Yeah, no, I would agree with that, and I think the way that I've kind of been framing it for clients over the last kind of day or so has very much been a case of we've now sort of seemingly avoided the worst case scenario on trade and priced that out, as in these huge punchy reciprocal tariffs that were meant to be going in. We now need to see evidence of moving towards a better case scenario for the market to build that more durable rally and take out some of those upside levels that you've just alluded to. So, in a weird sort of way, because this week hasn't been easy, but the easy part of the rebound is probably done. Now it's a case of, okay, fine, tariffs are on pause, but show us some progress.
I also think it's important in the context of what we've seen over the past few days. I've seen an awful lot of people compare this to the financial crisis in 2008, 2009. I'm sorry, I was there, right? This doesn't come anywhere close to it. During that crisis, we really thought that the world was going to cave, the roof was going to cave in. When Lehman's went down, it was basically a free-for-all for the exits. You just couldn't fit through. There were basically short selling bans and all manner of things. It was actually, a little bit scary because you felt as if you were completely out of control. Events were spiraling out of control. This isn't even close.
No, and the other thing, of course, I was going to say,
And
let's
hopefully
hope it doesn't get anywhere near that.
Yeah.
The other thing, of course, actually, speaking broadly, we saw quite a lot of nervousness in the Treasury complex at 3 o'clock in the morning on Wednesday, London time. But by and large, yes, it's not been fun, and markets have been very volatile, but markets have also been quite orderly the entire time. Volumes have been okay. There has been liquidity. Nothing has seized up that shouldn't be seizing up, etc., etc., etc. And I think that's something that people are struggling to draw a distinction between. A market can be very volatile and chopping around all over the place, but still functioning as it should. When markets don't function as they should, that's when we have a problem. And thankfully, we didn't get anywhere near that stage this time around.
And I think it's important to highlight that fact because I've seen an awful lot of nonsense on social media about that. And as I say, I mean, it's been choppy, but it's certainly been manageable. And if it hadn't been manageable, then central banks would have stepped in, and they haven't. So and they certainly did in 2008, and then some. So
absolutely.
okay, so let's move on because obviously the dollar's taken a bit of a dump again. Again, that's been really choppy. Euro
Yeah.
dollar's been basically chopping either side of 110 all week, and cable 30k was actually taken a big hit,
Mm.
or the pound's taken a big hit, particularly against the euro, which
Yeah, I was
I
going to
must
say it's
admit I'm
euro
struggling a
sterling
little
that's
bit with.
moved.
And so maybe you can shed some light on that.
Well, I was really hoping you wouldn't ask me that because I'm not entirely sure myself, to be completely honest with you. I think the sort of logical answer is if this is just purely a trade and tariff play, which you kind of got to assume everything is at the moment, it's a case of the trade or the tariffs imposed on the UK haven't changed. The tariffs on the EU have been cut in half. Net net, you would say that's a more positive outcome for the eurozone than it is for the UK. The other thing that I would potentially just bring to the table is, as we discussed earlier, the moves that we've seen in gilts, and I do just wonder whether the aggressive sell-off at the long end of the gilt curve has brought fiscal concerns and jitters back to the forefront of market participants' minds a little bit, and going, we're going to need tax hikes, we're going to need further spending cuts in the autumn, whatever it may be. And perhaps at the margin, that's had a little bit of an impact as well. But yeah, a bit of a head scratcher, I'm not going to lie to you.
Maybe I think maybe there's a case for arguing that the ECB is done
Oh, that's
on the
bold.
rate cut front, and ultimately, I think if this fiscal stimulus that was agreed, um, and the German government they formed a coalition, maybe there's some money going into euros on the basis of this 500 billion euro fiscal boost is going to happen, and the
Mm.
euro's taking a kick higher on the back of optimism about that.
Yeah, potentially. I mean, I think, as you say, that we did get confirmation of that coalition agreement and the plans to reform the debt brake that came through earlier this week. I think, arguably, most of that was probably priced earlier in the month, or even back in March, when we
Mm.
went from 104 to 111, or whatever the highs were at the time. Yeah, I'll go back to your ECB call. I think that's a bold one. I would argue the opposite. I think actually the events of the last week or so, even with a 10% tariff, probably nods towards deeper ECB cuts as opposed to them being completely done and dusted. Although we did hear from the Austrian central bank governor Holtzmann, who said that there is absolutely no case whatsoever for a cut this week, and we should just wait and see, which is very much an out of consensus view among his colleagues, it must be said.
Yeah, because we've got the ECB meeting next week.
Indeed,
Before we
next
get on to
Thursday.
that, um, deflation, US CPI came in quite a bit below expectations. We had Fed minutes this week. Nobody cares about them. They're dated. You might as well basically just tear the piece of paper up because the economic landscape has completely changed since that last Fed meeting. But China's in deflation. The US month on month CPI number, lowest in 5 years, minus 0.1.
Mm. Yeah, I mean, do you know what? I would view, and actually, we haven't mentioned it yet because so much has happened. But of course, we also had a much better than expected U.S. jobs report last Friday as well. 228,000 jobs being added, unemployment ticking higher, but that was mainly because of participation. I mean, the way I would view both is look how good the economy was in the United States. That is March. Goldilocks, a great labour market that's really tight with solid, real earnings growth and CPI coming nicely back down to the Fed's 2% target. And then you decided to take a wrecking ball to something that would have been the envy of the world.
Yeah, consumer confidence has taken a nosedive. It's fallen
Yep.
12 basis points. And then we're not talking the University of Michigan one here. We're talking
No,
about the
the
official
Conference
US
Board
consumer
Index,
confidence
yeah.
ones. And we've got US retail sales for March also due next week. So I think that'll give us a good indication as to whether or not US consumers have
Mm.
decided to keep their hands in their pockets. Certainly the consumer confidence numbers would appear to suggest that perhaps they are becoming more cautious.
Yeah, and I think the retail sales figure is going to be really important because, as you said, both the University of Michigan number and the Conference Board number have fallen off a proverbial cliff over the last couple of months. Also, we know the degree to which consumer spending powers the US economy. And as you say, if consumers don't spend, and if they do tighten their belts, then the economy is only going one way. I'm just looking here at the Atlanta Fed, and they, of course, put out a GDP nowcast. If you look at their model, which is adjusted for all the skew involving gold imports, they currently see the economy contracting by 0.3% on an annualized quarter-on-quarter basis in Q1. If we get a soft retail sales number, which all the leading indicators point to, it must be said, then that is only going to crystallize those concerns over a substantial slowdown in the US economy and potentially even a recession, considering that that's March data for retail sales. And from April onwards, we're going to be seeing the impacts of tariffs coming into the figures and higher prices potentially depressing demand even further.
That's going to give the Fed a bit of a dilemma then, isn't it?
It is. I mean, I think this is the sort of $64,000 question at the moment. What do the Fed do? And I think, judging from what policymakers have been saying, it's very much a case of the focus. Firstly, will remain on the inflation side of their dual mandate, and they will likely be probably on the sidelines for longer, given not only the rise that we will see in price metrics, but also in order to ensure that inflation expectations remain anchored. So I think anyone going, the Fed are going to step in really soon. I think that's probably misplaced. I think the Fed will want to be sure that that inflation impulse from tariffs is temporary or is transitory before stepping in. And they will probably only step in if they see signs of material weakening in the labour market, which I would say will mean, one, that they're probably late, and two, will probably mean that they end up cutting. Even when they do cut, they'll probably end up having to cut quite quickly.
But while the labour market holds up, there's no reason
They've
for
got
them
no
to
reason
really
to. Absolutely no reason
even
to.
throw a pebble in the pond, so to
No.
speak.
And that's exactly what we heard from Powell last Friday while you and I were having a beer together. Effectively, there is nothing in the data right now that says to the Fed, you need to act on rates. As we just said, yeah, we're backward looking, but in March, the economy was in pretty damn good shape.
Unlike the UK, where we've
Well,
got unemployment and wages data for February next week.
Good news, by the way.
Yes, and CPI. So
Indeed.
CPI for March. I'm sort of struggling with this idea that the Bank of England is going to be cutting rates anytime soon. Looking at the inflation numbers, we've talked about this before, and I don't see any reason to really go into a great deal of detail on it because the numbers are there. Core CPI is above headline CPI, services inflation is above headline CPI, and wages are above headline CPI. So even though you've got a stagnant economy or a stagflationary economy, the Bank of England will want to be sure that the inflation genie is back in its bottle. And certainly the decline that we've seen this week in crude oil prices is going to be good for the economy, because ultimately it will probably give more people more money to spend on other stuff because they don't have to spend as much as filling their cars up.
No, absolutely. I fully agree with you. As you say, I don't think we need to dwell on inflation for too long because it's pretty clear that we are heading higher and that's not going to change anytime soon. On the labour market side of things, of course, this data is for February, so we're nowhere near the figures showing the impact of the national insurance changes. That will be another couple of months until that becomes clearer. Although we did hear from the ONS today that, of course, we've said for months now that there are data quality issues with the employment data. Never fear, they are on track to fix the labour force survey, hopefully by November 2026. And these issues, by the way, started in 2023, and the ONS further said that they hope that the transformed labour force survey will be able to be used from early 2027. I mean, that is utterly farcical.
That is about as much use to policymakers as a chocolate teapot.
Absolutely, and I mean, realistically, if you assume that the data quality issues were probably there before the ONS realised they were there, you're basically talking about an entire economic cycle where economic policymakers, be it monetary and fiscal here in the UK, have had, and market participants, have had no concrete idea whatsoever of what the jobs market is doing. It is an utter disgrace.
I was just reading, so I wrote this down in my blog for this week. January numbers showed wage growth remained steady at 5.9%, with unemployment also unchanged at 4.4%. Although these jobs numbers remain highly suspect due to a large drop in the number of people willing to complete its survey forms. You mean people
Yeah.
are having to fill out survey forms? I mean, are we
Yes.
still living in the 1900s?
Well, yeah,
Why is this not automated?
the other one that I heard, and I've got no reason to disbelieve this, is that and this is quite frankly farcical, but one of the issues the ONS were having is Ring video doorbells, because people now have a video doorbell. They will get a knock on the door from a man at the ONS saying, "Can we ask you some questions?" And they'll just be sat in bed and go, "No, sod off." And that's one of
Sounds
the
like
reasons
me.
why their survey response rates are falling. I mean, it's utterly ridiculous. As you say, are we in the bloody Stone Ages? The other one, and I've spent far too much, I've got a lot of time on my hands, clearly, to do this much research on it. Inflation. The ONS employ people on the Monday of the reference week to ring up hotels and ask them how much a room would be for that night. I mean, surely you can automate the hell out of collecting this data. The whole organisation needs, some sort of root and branch review at this point.
Why not just Google hotel rates on Expedia or Bookings.com? I mean, that would be
Honestly,
a hell of a lot easier. Sort of just do an AI generated search.
I
That would
know.
probably tell you,
Honestly, mate, I was flabbergasted when I read about this. Yeah, utterly
I can't believe that
ridiculous.
you're making it. I'm just checking that it is April. It's April the 10th, not April the 1st.
Yeah, I'm just 9 days late.
Yeah, well, bit like the unemployment numbers, really. But okay. Anyway, after trying to digest that, I really don't know what to say. Yeah. We talked about, actually, there is some good news. FTSE 100 is up today. Posted some fairly decent profit numbers. Worst performer, along with Sainsbury's, on the FTSE 100 today because they downgraded their profit expectations for next year to below £3 billion. They've done a share
Yeah,
buyback, another share buyback of 1.45 billion, announcing today. And yet the shares have dropped to the lowest levels since last July.
yeah. I mean, I would imagine that the buyback was almost just to sort of sweeten it up a little bit and try and soften the blow that they knew that guidance cut would inevitably cause. And I think it's worrying on two counts is, firstly, the guidance on its own, but secondly, the fact that they and a lot of the other grocery names are trading in pretty poor fashion when the broader market is up, 4 or 5%. That's not a particularly great sign, is it, that one?
It's not, but I think there's also an awful lot of pessimism about the retail sector. Obviously, they're going to have to absorb all these costs, these
Yeah.
additional costs that have been imposed by the government. But these costs have been well known about.
Hmm.
Looking at Sainsbury's shares, they're also down. They're posting their full year numbers next week,
Yes.
following on from Tesco's. But I'm looking
And
at the
they will be
numbers.
very closely watched now, of
Well,
course.
exactly. I mean, but the thing is, they're probably priced in now because they've fallen along
Yeah.
with Tesco's share price. So the actual numbers, like-for-like sales growth of 3.1%, with the UK market seeing a 4% increase. Revenues rose 2.5% to £69.9 billion. In fact, the only area of weakness in the business, the entire business for Tesco's, was in the Booker business, which is
Mm.
obviously logistics, food delivery, and what have
Yeah.
you. I found this particularly interesting because maybe it's emblematic of a wider problem that could hit the UK economy going forward. Business supplies, it's its best food logistics business. This business supplies the likes of Burger King, Pret a Manger, Pizza Express, Zizzi's, Nando's, Pizza Hut, saw a like-for-like sales decline of 5.1% to £1.44 billion. People aren't eating out.
Yeah. And that is particularly when it's those. sort of middle market restaurants, I guess, for want of a better word, Pizza Express, places like that, when people are sort of reserving eating out for special occasions or not even eating out at all,
Mm.
that's never a particularly great barometer of an economy's health. There is another barometer of an economy's health, but it's really not PC for me to mention, so I'll tell you afterwards.
Well, you can tell me over a beer later. We've also got B&M European Retail, who are a budget retailer. Their shares have been absolutely hammered. I'm not really understanding why, because ultimately their numbers are fairly decent. They're expanding pretty much across all of their business areas, France as well as the UK. They did announce that their CEO was stepping down, retiring in February, and they did announce a downgrade to expectations for group adjusted EBITDA. But again, looking at their share price, you've got to think to yourself, how much of that is already in? Because when you compare it to other retailers, it's done pretty poorly, and yet the numbers appear to suggest that they're in a big expansion cycle, and companies don't do that if they're losing money and not doing well.
No, absolutely. So nothing is a certainty, of course, but you do wonder
No.
whether it's a question of sort of when rather than if they begin to rebound as a result of that, given the discount they're trading at to the sector at large. Excuse me.
That's all right. Now we've also got Deliveroo's first quarter numbers. Their full year numbers, they posted their first ever profit. So I'll be very interested to see whether or not the Q1 numbers that we're due to see next week on the 17th support a fairly optimistic outlook that Will Shu gave in his end of year update. I think it was January, February. I can't remember when it was.
It
wasn't
long
that long
at all.
ago.
No.
Because it feels like we were only talking about them the other day.
Yeah, well, we probably were. Yeah, it doesn't feel like it was long ago at all, actually. But no, like you say, it will be interesting. Obviously, now they've recorded that profit. I think it's a question of can they build on that? It's not a case of one and done. It's a case of actually, let's use that as a platform to progress.
A couple of other things. Obviously, we've got JPMorgan and other bank earnings season starting on Friday.
Tomorrow, yes.
Tomorrow. We've also got some UK numbers out again that should give us an insight into what's going on under the hood of the UK economy. But next week we've got Goldman Sachs, so that'll be a continuation of the banking theme. And I think, given the volatility that we've seen this past couple of weeks, will the banks downgrade their business area expectations for certain sectors? Investment banking, asset and wealth management. Asset and wealth management was a really good money earner for Goldman Sachs last year. Well, wealth management has taken a little bit of a battering over the course of the past couple of weeks. So it'll be interesting to see what Goldman Sachs comes out with on the 14th.
Yeah, I think bank earnings are going to be really interesting. Firstly, because Jamie Dimon now runs the country. If you heard what Trump was saying yesterday, I saw Jamie Dimon on Fox and he said something had to be done. Okay, can we just install him as president? Because he's probably going to do a better job. But on a slightly more serious note, the bank leadership commentary will be of interest. And I think you've hit the nail on the head. It's probably because a lot of this vol, of course, has come in the second quarter, but even in Q1, we were chopping around all over the place. So I think it's going to be a really good quarter for trading, for equities revenue, for FIC revenue. I think it's going to be a potentially ropey quarter for wealth management, for consumer banking, and certainly for deal making and M&A, which expectations were really lofty that Trump's going to come in, the floodgates are going to open, the IPO market's going to be on fire, yada, yada, yada. Well, the complete opposite has happened. And actually, we've now got people pulling IPOs because of the volatility that we've seen. So for the banks, it's a question of how do they net off? And where does that leave the overall position? And then moving forwards, how is each likely to evolve? Is volatility going to remain where it is? For our sanity, I really hope not. And are the other parts of the bank going to be able to sort of start pulling their weight a little bit more?
Yeah, I mean, I wrote that I've written that in my blog in the Goldman Sachs section. I said optimism over a surge in M&A and other deals drove gains in the banking sector in the early part of this year. That's gone. So the big question is, will it be replaced by something else? Volatility sometimes can generate an awful lot of revenue, but will it be enough to offset the loss of revenue in other areas of the bank? And I think that's the big question that remains unanswered.
Yeah.
Let's finish off with one of my favourites, Netflix.
That caught me by surprise. I didn't know where you were going with that.
Okay. No. It's Netflix. I've followed Netflix for years. And many years ago, I was basically writing about the fact that they never hedged their forex exposure,
Oh
which
yeah, I
I
remember you
found
telling me about this.
mind-bogglingly stupid, given the fact that an awful lot of their business, their
Is
key growth
overseas.
areas were Latin America
Hmm.
and Asia. They're one of they're the only streamer, I would argue, that has a global footprint.
Yeah.
You can't really say that for Disney because essentially Disney don't make content for their local markets like Netflix do.
Yeah.
Netflix make local content for their local markets and sell it direct to there. So an awful lot of their revenue comes from overseas. Now they started to do that. They started to do really well. And one of the things that I took away from the last set of numbers was that Netflix shares actually haven't been that badly caught up in the sell-off that we've seen over the course of the past few months. Yeah, we've declined gradually lower, but we haven't fallen off a cliff. The decline has been fairly orderly, and essentially we're back where we were just before those Q4 numbers came out. Those Q4 numbers are really, really good. They added a hell of a lot of subscribers in that fourth quarter. 18.9 million subscribers they added, which was well above what markets were expecting. As I say, you look at FX rates, operating margins, 28.2%. I mean, that's pretty good when you consider the industry they operate in.
Yeah.
Streaming, where there's an awful lot of what I would call churn.
Yeah, no, absolutely. Certainly, given how competitive it's become. But yeah, one to watch.
Absolutely. Okay,
That
so
was all.
bounced off the 200-day moving average, moving back towards 1,000. So it'll be interesting to see, what that tells us about the global streaming industry. Anyway, that's it. I think we pretty much covered everything.
We've done well to do that in 57 minutes, given how much has happened.
It's a lot. So unless there's anything else you want to add, Michael, I think we'll wrap this up. And
No, nothing from me.
hopefully markets will be higher and not 500 points lower,
Yes.
which they are this week from last week. Fingers crossed that we get to paint a much more positive picture. Well, I suppose we have painted a reasonably positive picture, even though we're 500
even more
points
positive next.
More positive, hopeful, cautiously optimistic that perhaps the worst is behind us.
Indeed.
But again, that all depends on our friend in
the Orange Man.
Yeah. Indeed. All right, so that's pretty much it for this week then. We'll wrap this up and we'll talk to you all same time, same place next week. Thanks very much for listening, guys. And any questions, just stick them in the comments.
Bye for now.